I do think that this is more of a UK one than a US one. UK, we're running a large budget deficit. We're going to be on our own out of Europe in some way. There's going to be a lot of concern about that. We've definitely got inflation in the UK coming, 3% next year. You know, why would you want to actually pay the government, get from the government a 1% yield for taking a 3% inflation? Sooner or later the markets will not do that, however much QE you push at it. So I see rates actually rising quite rapidly in the UK over the year or two forward. We're running a big current account deficit. We'll have pressure on the currency continuing, and then we could get into really quite nasty territory. We would, at some stage, you need to start knocking the head on inflation and rates rise quickly. So I think there's a scenario which is much worse than we're going to go to 2.5% or something for base rates. I think we might see 5, quite easily. 5 is still, I think, the average of the last 25 years or something.
But it'll be a real sticker shock to those who've been living in low rate land since the financial crisis.
But it'll do some good as well, the higher interest rates. We'll start to see Darwin operate on our corporations, so we'll see the weaker companies actually tip out the good assets and the good people and put them into better businesses, because we don't have a very high business failure rate. We'll see inequality actually reduce. We'll see the asset bubbles reduce. So it's not all bloody terrible for rates to go up. What is terrible, though, is the potential impact of pension funds and the like stuffed with gilts as the capital value of those gilts comes hurtling down. And you'll see the asset side of pension funds and insurance companies look very tricky. They've got very used to living on these tiny, thin margins. And when you look at the numbers, they're quite frightening. They've got lots of long gilts. If the market rate goes from 1.5 to 4.5, they've got a hell of a write-off.